Hey guys, what's up? Damon Varial here. I don't have the webcam on today because I am shirtless at the moment. And I also don't look so great seeing as I've been up for, let's see here, 3 days straight. I've pushed it 3 days before, but I've never gone past 3 days. Usually hallucinations kick in when I stay up this long. I'm doing pretty well this time. I actually might make a video about seeing how far I could push it. But for now, what we're going to talk about is seasonality in the stock market, more specifically what we expect to be happening in November. So there's a lot of weird controversy around what happens exactly in terms of sector seasonality and in terms of the elections in November. All right, we're going to deal with the sector seasonality first because that's the easiest to deal with. Now, a lot of people just hear from a pundit or on a website that there's a certain seasonality per sector and they take that to be true. What I have is a book called, let me see here, The Stock Trader's Almanac, and it lists the seasonality for each sector. Now, what I hope to do today is investigate whether what that book says is true or not, and a preliminary investigation shows that everything it says is pretty much wrong, at least in regard to November. So we're going to look at these one by one. We're going to start with the one you're looking at right now. So this is my R code. You can ignore it. What you want to be looking at here is, I'll make this bigger, but you want to be looking at the image on the right. What this shows is going back from whatever date we have the beginning set of data for the seasonality in 4 different charts. So on the top left, we've got the Sharpe ratio, which is essentially the risk-reward profile. If it's positive, it's generally going to be a good investment. And if it's 0 or negative, generally what you got is high opportunity costs, and you probably want to put your money somewhere else. This min chart is the minimum, the major drawdown, in other words, that you won't expect it, but that we've seen in the past. So, for example, UTY, by the way, is the utility sector, and I don't think it's leveraged, though we can check real quickly. When you want to trade in a sector, you generally want to deal with some sort of ETF. Now, UTY is not looking like it works here. Maybe if you type in the name, it brings up a utility ETF. I mean, that's what we had right there. We'll use UUO in this case. Alright, that's not popping up either. So we go to the trusty little stockcharts.com here, and we'll check out that ETF. So the idea here is you want to trade on an ETF that moves as the sector moves. Now, as you can see, the utility sector has been dropping since July. The Stock Trader Almanac says that the utility sector generally is in bullish season from March to October. So its strategy tells you buy in March back here and then hold until October here and then sell. In other words, around this time we should be expecting the utility sector to drop. That's their theory, but my data shows otherwise. It actually shows that the Sharpe ratio for November is actually quite good. And now is probably the best time to buy the utility ETFs. So we're at a relative low anyway. And if you bought now, and if this seasonality comes into play, we will profit. Now, this is where we want to look at this percent positive down here. And this is where we see that most of the months, even this month, November, are not positive. So we have a technical bearish season here, and the best time to invest appears to be December. But if you look at the Sharpe ratio, November has the least amount of drawdowns, and it also has the most gains. Now, why that is, you could probably go back and look at the history for those two, for one significant event, which is when the utility sector jumped. But it appears like November is the safest to invest, not because of how often it moves upward, but because of the risk involved. You don't expect to lose a lot in November, even if you're getting in to lose. And we don't want to get in to lose, but because that drawdown is so low compared to all the other months, November seems to be the best time to get in on this sector. Now, the almanac tells you otherwise. It tells you sell. It tells you to get in March, which is the worst month, and then sell at the end of October, which is just wrong. Apparently, I was thinking at the beginning maybe they switched bull and bear, long and short, but it doesn't seem to be so, because if you look at the other ones, we find a similar pattern. So let's move into the transportation sector, according to them, is going to be bullish from now on. So they advise people to buy DJT. That's a transportation sector. Let's check this out. DJT. Run that. Let's see if we can find it in here. And E-Trade Pro is not working for me. Nor is this. So we're going to look for... I mean, these are indexes that we're looking up. Maybe that's why they don't show up. There we go. But I want to show you guys stuff you could actually buy and hold on to. And it appears that we might have to use the X's. For every sector, there's an X, like XLU. That would be the utilities that we were just looking at. And you could obviously play that if you wanted to. What is transportation? Is it XTU? XDU? XJU? Alright. Well, you might have to look that up on your own. Let's take a look at the seasonality, though. And this is the main result you should be drawing from this video. Whether it is correct to trust the seasonality of the almanac or whatever you read, the answer to that question is always going to go back to the data. You've got to back test it. Now, if you look at the transportation index, we see that the best time to invest is actually in October, and I think that's what the almanac actually said. So they were right in this case. The almanac says that transportation should be short from July to August, and that looks pretty good. Not July to August, July to October. That looks pretty good, but actually I would say August, the end of July, or beginning of August to October, to the beginning of October, the end of September looks much better. You might have missed a bit of the gains here, but that's okay, because another thing I wanted to point out in this video is that November is usually the second best or third best month of the year for a bullish market. So if you're still bullish on the stock market, November is a good time to get in. Now, of course, you want to get in to the right sectors, or at least if you have a wide selection of stocks that you're looking at or have on your watch list, you want to buy the ones that are most likely to make gains. We're talking about investors here, not traders, of course. But if we're looking for those gains, we want to trade in the direction of seasonality in almost every case. That will decrease our risk, and if we are correct, and even if the stock were to trend sideways, in other words, the seasonality of the entire sector is likely to bring it up. Now, let's look at the third one. So we've looked already at transportation, which looks pretty good, but you might be getting in too late. We looked at utilities, which the seasonality says to get in on, even though the books say to get out of. Now we're going to look at two more here. One is the oil sector. Now, there's a caveat here. Oil this year has been very weird. You might not want to trust seasonality this year, but I'll put it out there for you anyway. While the almanac says that November should be a long position, they are correct here. They, I think, give you a little lag here because it seems that October is the better time to start investing in oil. And it's the winter months before January that oil tends to rise. So if you have been speculating on oil, or if you're looking for an oil turnaround, you could probably expect it within these 3 months, or early next year. Unless you have a good fundamental understanding of oil, I say stay out. Don't trust the seasonality, at least for this year. And we're going to move on to the final sector here, which is the semiconductor sector. So I have been looking to short, actually, a certain semiconductor stock and long another one. So this became something of interest to me anyway. Now, the semiconductor sector is one that moves very quickly. It's of high volatility. This alone can bring in high gains if you're in the right direction. If you're following the drift, then you can get a lot of gains just from investing. You don't have to trade this sector. And as we can see here, even though the almanac says that this is the time to go... Oh, they're okay here. All right, so they say that the time to go long in the semiconductor sector is in October, which is actually 100% correct. So that's what we got. They say the end of October brings a rise. I'm not sure if we saw that this year. It should be SOX L, actually. So it looks like October is pretty flat. And now that we're in the last week of October, this could be your entry point to the semiconductor industry. If you're going to play options or stock, I recommend you go with SOX L. That's a 3 times leveraged ETF, but only go with it if you're going to hold for a short amount of time. The problem with all of these leveraged ETFs is that you're going to lose money in the long term because of how the price of this ETF is recalculated each day. What happens is day traders can take advantage of a specific aspect of these leveraged ETFs and make money pretty consistently every day. And you've got to ask yourself, where is that money coming from if we're just playing some sort of weird arbitrage on the ETF itself? Well, that money's coming from you, the investor who holds on to the ETF for a long period of time. Those error fees are taken out of the investors' money and given to the traders, which is generally not something investors want to hear. So if you're going to hold on to one of these, don't do it for too long. I would recommend actually going into the semiconductor sector and picking out some stocks that you think will do well instead of holding this. If you want to know my picks for the semiconductor sector, you can sign up for Exposing Earnings. We're going to look at an earnings report for a certain semiconductor stock in the coming week. And then we're going to move on to actually one more here, because I just saw in the almanac it says that November seasonality here. Alright, so November seasonality, they say that the real estate industry begins to pick up. Now when I trade real estate, I trade DRN, which is 3 times leveraged ETF. I remember I made good money on this. I think last year. It was more expensive then, I guess. Yeah, I was trading, well, I mean, it's always the same. Maybe it was DRV, the inverse. It's all about the same. I don't know. Anyway, there might be another one that trades at a higher price. But for now, I'd say if you're going to trade real estate, go with DRN. And if you're going to invest in real estate, go with RMX. Is that wrong? RMZ. Sorry. There you go. RMZ. Okay, that's wrong too. RMZ. You can tell that I am not exactly familiar with the normal ETFs. I have traded a lot of the leveraged ones, and now I'm trying to give suggestions to people who want to buy and hold. My only suggestion is don't do it with the leveraged ones. Unfortunately, I don't have all of the non-leveraged ETFs in my head, so you have to look them up. But let's check this out. Is it true that real estate starts to go into its bullish? Let me check. Yeah, bullish phase according to the almanac in November. Let's check that out real quickly here. We're going to do it with the leveraged ETF. And what we see is that November is typically not the best month to invest. It's usually not positive, and the Sharpe ratio is negative. However, December seems to be the best month. December has never had a bad month in the last 7 years. So since the real estate market crash back in 2008, we have had a good December every year. That's something to take into consideration, not only because that's the statistical trend, but also because, like me and like you, we have quants, people who do quantitative analysis and give their advice to firms, hedge funds, banks to buy. And if they know, or if their models find that December is a very safe month, then it becomes a self-fulfilling prophecy. What happens is people have faith in December being a strong month, so they buy in December, and generally things don't really go wrong. So based on that, we not only know from the data, but we also know just from human psychology and the way that the stock market works, December is probably a really good month to buy any real estate ETF, and it's probably a good month to buy some real estate stocks after you do your own due diligence on those companies. Now, am I going to trade this? I probably will if I remember. If I remember come December that this is a really good month, I might make a note. But I have so many things going on, I often forget these seasonal plays. I don't really do many seasonal plays because I don't like to hold a position for a month or more. But this one looks really worth it. The average gain in December is 10%. The Sharpe ratio is way higher. It's almost double the second highest, which is in July. And July is also a really good month because it has also 0 drawdowns in July. So we've got a perfect July, perfect December for this sector, but November is not the time to get in unless you're going to get in at the end of November. Now, with all that said, we should come to I guess there's one topic to talk about before we go to the election issues, and that is earnings. We are approaching Q4 earnings, and Q4 earnings tends to be the best bullish earnings month to play. So if you're interested in that, please check out Exposing Earnings, which is my newsletter on Seeking Alpha. We will be looking at some good earnings plays in the bullish direction. All right, so now let's get to what a lot of people are discussing, which is the election. And I'd like to pull up some pictures or something, but forget it. Just sit back and relax and listen to my beautiful voice. Generally what happens in the election year is we have a certain type of seasonality that's much different from pre-election and post-election years. So we can't look at every year as the same. We can't say that, December of every year is going to be the same. We have to look at it in terms of election years, because we actually do see that the stock market moves differently whether there's going to be an election or not, or whether we just finished an election, or whether there's not going to be an election for another year, which is typically the best year. Like last year, we had pretty good gains as the seasonality of elections predicted. Now, what happens during an election year? And what happens when the election comes? And what happens if Trump wins? Or what happens if Clinton wins? Okay, let's answer this once and for all. Now, the election year, first of all, Q4 is generally a really good quarter. In starting December, election years typically are pretty good. Let's pull back 1 year here. Election years are typically pretty good. So we've got whatever we see in October to generally continue throughout the other months, but becoming stronger. Now, this October, we didn't really see many gains. It trended sideways in general. And what that means is some sort of undecisiveness, some sort of indecision. Because what happens in the stock market can predict who's going to win the election. This has held true, I believe, for every election in the modern era. So like the past 50 years, we've seen the same phenomenon happen over and over. And that is, within the previous 3 months. So the 3 months before the election actually occurs, if the stock market moves upward, if it drifts upward, that has always implied that the winner is the incumbent party. So if we now let's ignore the chart for this year for the moment. So if we had seen that the stock market has been bullish for the past 3 months, we could bet pretty safely that Clinton would be the victor of this election. Now, likewise, if the market trends downward, it's been the case in every election year that the incumbent party loses. Now, what we have is actually a trending market that's, a consolidating market. In other words, we don't know if it's really trending upwards or downwards because it's just not going in either direction. So at this time, it's too early to use the stock market to predict who will win. And you might want to take that phenomenon I just described, which is correct in either like 100% of the time or 95% of the cases. You might want to take that with a grain of salt anyway, because think about all the different ways people have tried to predict elections and found that these statistics are really high for a certain prediction process. For example, I remember that there was a study that showed that it was something like 80 to 90% of the elections can be predicted by which candidate is taller. The taller one almost always wins. Clearly, that doesn't always work. It has failed in the past, and it could fail in the future. But what I'm trying to say here is that because we have all of these different election prediction methods, don't just use the stock market to predict the election. Now, why am I even talking about predicting the election? Because if you correctly predict the election, you can predict with pretty good certainty which way the market's going to go. If the incumbent party wins, we've got status quo, and the market will probably continue as it is, probably just slowly drift upward. If the other party wins, it depends on how America sees that person's effect on the economy. And generally, just due to fear, the market will tank at the beginning. So you can expect a quick drop if Trump wins. Now, after that drop, we'll probably see some buying, and that will bring it back up. And then from there, who knows? The economy might get better, it might not get better. It doesn't really tell us anything about the future. We just want to know pretty much like what will happen at the election. Because if we know that, then we can play the same thing that many people played on the Brexit decision. Now, if you recall, Brexit was back here in the, that was late June. So that was the Brexit decision that freaked people out, and the market dropped. So this is probably what the market will look like if Trump wins. We've got kind of a sideways trending market, some apprehension about whether Trump will win or whether Hillary will win. And if Trump wins, it'll probably drop real quickly, and that will present a buying opportunity. And at that time, you can just buy stuff up. Now, also, if you're able to predict, if you have a pretty strong idea of who's going to win, what you can do, I'm not saying you should do it because I'm probably not going to do it. What you can do is you can make bets in two different markets. So what you might want to do is, let's say, I'll just use one example and you can figure out the second example because there's only two, right? Let's say you believe that Trump is going to win despite the odds in the betting market saying that Trump is going to lose. Now, what you could do there is you've got two options at that point. The first option is you can go directly to the election betting market and bet that Trump will win. They will give you pretty good odds. I'm not sure what they are, but let's assume that they'll, triple or quadruple whatever money you put down. Now, what if you're wrong? You lose all that money. So it's like a call option. And that's the great point, because what we're going to do is you're going to buy essentially what is a call option in that election market, and then you're going to buy call options in the actual market. Or not call options, you wouldn't want to go with call options because call options are long volatility. If you don't know what that means is, well, let's see here. Here's SPY. All right, the election will be over in December, so let's go out to December 16. All right, so here's some call options on the SPY. If you look at Vega, Vega is the price change of the call option for every 1% change in market volatility. I'm getting a little more complex than I wanted to get here. So let me take a step back and explain that trade. And then I will go into the complexities. So here's the idea, right? Let's say, I'll explain both of these examples real quickly here. You bet that Trump is going to win in the election betting market. If you win, you get 4 times your money. At the same time, there's going to be an issue with if Trump wins, if you're wrong and Trump loses, then the market's probably going to continue upward or trend sideways. This downward drop that happened during Brexit will probably not happen if Clinton wins. So what you want to do here is you want to hedge. Now the hedge is simply this. Make the Trump bet in the election market, and in the stock market, make a long position. So I'm not even going to talk about options here. Yeah, forget it. I'm not going to talk about options here. I don't want to get it too complex. So all you do is you buy stock. Buy stock in the market, and you bet that Trump will win. Now, if Trump wins, you get 3 or 4 times your money back in the election market, but your stock's going to fall. However, it's okay because it's going to climb back. You'll be made whole after a week or so, and then whatever happens after that is fine. Now, what if it's the opposite situation, and what if Clinton wins? You're going to lose the money that you bet on Trump winning, but the stock market will continue upward, and you won't see that little dip there. Now, in that case, you'll be okay because you have a long position in the stock market. That was your hedge. Now, hopefully, you're going to use options. I'm not going to talk about them here again, but you will use options so that the tiny bump up we see after Clinton will make you more than a tiny profit, and therefore at least make you break even on that bet. The idea of the hedge is a certain type of arbitrage where you make bets in different markets, and if something happens, the movements in those markets, no matter who wins, move in your favor. So let's look at the other example, which is you take the safer bet in the election market and you bet that Clinton's going to win. Now, you might bet $100, and if she wins, you might only get $130. So you only make $30 profit on your $100 bet. That's not a lot of money, but what happens if you make that bet with a lot of money because you believe it's very safe and very likely, and just because you're afraid that maybe Trump will win, you buy put options or you short the market. So that if he does win, what happens is when we hit that little bump right there, even though you lost money in the election market, you made money in the stock market because you were in the downward direction. That's the entire idea of the hedge here. So that's something you can play in the election season coming up. But overall, the takeaway here is that the sectors that are said to be really good in November really aren't that great. There's a few that begin their bullishness, not really in November, but actually more in October. And it looks like the utility sector is pretty good. And you should keep your eye on that real estate sector because in December, it goes up in a very safe and reliable way. Let's actually check that out real quickly from last year and see just how much it moved. Okay, so here we are. All right, so here's December, and indeed, you've got that up month, up into January and all the way into February, which I don't think is always true. It looks pretty good. So actually, if you're into real estate, buying in December and then holding all the way through until April seems to be a pretty good strategy. You can get out earlier and take your profits, and that would have, you would have done pretty well last year. So consider it for this year. hopefully we do see seasonality. If we go back 10 years, we'll see kind of a wave sinusoidal pattern here. It's often hard to tell as the stock market increases because we're doing it on an upward drift. But generally, we could expect these spikes to be in December to when? December to April, I believe. Yeah, December to April. Not true here. That's end of April. That's in January. So if you're gonna play real estate, I suggest you wait until December. As for what you can buy in November, well, consider the election question first. If you think that Trump's chances of winning are not that great, then go ahead and try something like utilities. Again, the utility one was UTY. That's the index. Shit. Well, look up those ETFs for whatever sectors. Hopefully you're taking notes. Of course, you could just watch the video again. But again, if you don't believe that Clinton is likely to win, expect kind of a Brexit event. Be ready to buy the dip. And if you want, preparing to go into the election, open some short positions. So when that dip happens, you can take some profit right there. But that's pretty much what I expect for this November and what you can expect for pretty much every November. And there you go. That's seasonality. Don't forget to subscribe, leave comments, requests, blah 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 blah.